I will have to add that you've been correct so far since I started speaking with you earlier this year. So congrats on your calls,
Thank you for
Sam.
that. Much
I do want to.
appreciated.
So what's changed in the last year that have made people A, more bullish, and B, um, shocked the bears who have so far, I guess, been wrong about the strength of the economy?
Oh, you're absolutely right. Yeah, and when I was, doing both client meetings and media, earlier in this year and late last year, that was very much what I heard and what people were telling me, and they definitely disagreed with me in being more positive on equities and on the economy. And I think the thing that a lot of people have overlooked is they've overfocused on the Fed, on monetary policy, and underfocused on fiscal policy.
Sam Burns returns to the show. He is a chief market strategist at Mill Street Research, and we'll be talking about his macro outlook. Welcome back to the show, Sam.
Hi, David. Thanks for having me.
Let's start by analyzing the trends in the stock markets. Everyone's wondering whether or not the peak in late July in the S&P 500 was indeed the peak for the entire year. What are your views?
I suspect it probably wasn't. I think the stock market has enough momentum internally and support from earnings to continue to work its way higher through the rest of this year. Probably not as dramatically as it did in the first half, but I think it will still continue to work higher. Most of my indicators are still net positive.
Okay, tell us about these indicators.
So most of them, picking up the improvement in trend and risk appetite that we've seen all year, but really since the March, April worries about the banks. We've seen a real improvement in a lot of different metrics, both in terms of people being willing to buy higher beta stocks, credit spreads in the high yield and high grade markets have come in. So I think there's been a lot of improvement in people's views of the economy and of the market itself. And then you've got a little bit of that FOMO kicking in. People who have been underweight equities earlier in the year now trying to catch up. So I think there's probably a little bit more of that to go as well.
Goldman Sachs released a note earlier in the summer saying that short covering in U.S. macro products, which included index funds and exchange traded funds, reached the largest amount since November 2020. So it seems like some of the rally, or at least a big chunk of it, was partly driven by short covering. Now, that's probably mostly over. So perhaps if that's done, we could see less momentum. Do you find any credence in that theory?
No, I think that's right. I think the really, powerful up moves that are driven in part by fundamentals and in part by short covering are probably behind us. But I think the fact that earnings estimates are still rising and the fact that there's still, I think, some money that hasn't been fully committed. I think that when you look at the sentiment surveys and things like that, they've definitely come up a lot. There's more bulls now than there used to be, but we're not nearly at an extreme like we would have seen at the peak in 2021 or at previous historical peaks. So my guess is that as long as the economy is doing okay and earnings estimates are rising, I think that there's still some fuel for stocks to work their way higher, just in a more kind of choppy grinding action than the sort of straight line moves we saw in, say, June or July.
I will have to add that you've been correct so far since I started speaking with you earlier this year. So congrats on your calls, Sam. I do want to. Yeah, I do want to touch on. So yeah, you are still constructive on the index overall. Which specific sectors do you like more than others?
I'm still seeing positive trends in technology and consumer discretionary and industrials. So some of the more cyclical and growth areas still have some fundamental tailwinds in my work. And we've seen, as well as areas like consumer staples, which is a more defensive area, but has also seen some improvement in the U.S. in my work. Some of the commodity sectors, have remained relatively weak, even though we've seen a bounce in oil lately. And one area that's actually started to look less bad, I guess, that's been out of favor for a long time has been real estate and REITs. Where I've started to see signs of that kind of second derivative things are not getting worse and maybe getting a little better at the margin than they had been for a long, long time.
Don't you think that the real estate sector, in particular the commercial real estate sector, is in a lot of danger right now, especially considering that commercial real estate is already down about 30%, and we could be seeing some more defaults coming as people have to refinance at a higher rate? That's one risk I've heard. What do you think?
No, I think that is a risk, specifically for the kind of slice of it that's office, commercial office real estate. I think that's where a lot of the weakness is. And that part of my work is still relatively weak. But if you look at the broader kind of scope of real estate, commercial real estate, hotels, restaurants, all those kind of things, resorts are doing well. Some of the retail related stuff is doing well. Industrial warehouse kind of stuff has been doing better. So there's parts that are not office buildings that are within that kind of real estate and REIT bucket that I actually have been seeing some improvement and that are more driven by consumer demand rather than people going back to the office. So I think there's definitely more of a bifurcation now within the kind of real estate space that some areas have started to improve and some are remaining weak, like the office space that, as you mentioned there.
Well, let's back up a minute before we drill even deeper. Why is the economy still doing relatively well? If you had said the exact same things that you just told me a year ago, people would have thought you're nuts, or at least just disagreed with you. And in fact, many Wall Street firms had a negative view last year. The Bank of America, for example, their chief economist had a negative outlook and expected a recession by this time this year, last year. And now recently, over the course of the summer, he changed his tune and said, we revised our outlook. Now we're seeing a soft landing this year, no more hard landing in light of recent data. So what's changed in the last year that have made people, A, more bullish, and B, shocked the bears who have so far, I guess, been wrong about the strength of the economy?
Oh, you're absolutely right. Yeah, and when I was, doing both client meetings and media, earlier in this year and late last year, that was very much what I heard and what people were telling me, and they definitely disagreed with me in being more positive on equities and on the economy. And I think the thing that a lot of people have overlooked is they've overfocused on the Fed, on monetary policy, and underfocused on fiscal policy, and that's in some ways you could say that's understandable just because the Fed certainly gets a lot more attention. It has a lot more direct impact on financial markets than fiscal policy. And certainly fiscal policy in the past cycles, a lot of the last 20 or 30 years, really hasn't been the big driver that people have focused on. It's been much more on monetary policy. But I think that's been sort of an incorrect assumption or a limited one, meaning you're missing part of the picture if you're only looking at what the Fed is doing and not paying attention to fiscal policy. So I think that's been the thing that's really been different. Is you had the COVID stimulus, which has sort of a long tail to it, and then you've gotten the CHIPS Act, the Infrastructure Act, the Inflation Reduction Act. All those are pretty big and pretty kind of long. Also have longer lasting impacts on the economy than I think a lot of people thought. They just don't show up and have a press conference every 6 weeks to talk about them, so people kind of lose sight of them. But I think there's been a lot of activity that's been supporting the economy and keeping it from going into that recession. People were assuming would happen because the Fed's tightened rates aggressively and all the COVID stimulus was going away and all those other arguments that people made for why we'd be in recession now, and we're clearly not. The employment jobs market has held up a lot better, and the supply chains have gotten better. And now you've had this kind of more technology and infrastructure related spending that I think is helping to expand capacity and keeping people employed.
Well, that's a very interesting point you brought up, Sam. If fiscal policy has indeed had a strong impact on the growth of the economy, then couldn't you argue that even another 25 basis point or even 50 basis point rate hike would have a limited effect on bringing down inflation to the Fed's 2% target? I'm talking specifically about core PCE inflation, which is still above 4%. That's their preferred measure.
That's right. That's right. No, I think the Fed's, a quarter point here or there at this point is not going to make a big difference in the overall trajectory of inflation. My view is that the general trajectory of inflation is still lower. I think it will continue. Even core PCE will continue to decline. It'll be choppy, but it'll continue to decline over the next 6 to 12 months, partly because of the influence of housing costs and rents. But I think other factors in general are still relatively disinflationary rather than inflationary at this point. I don't think the economy is growing fast enough to generate inflation by itself. And I don't think that, I think monetary policy and certainly bank credit is slowed significantly, which is what the Fed has wanted. And that's really the direct impact of the Fed is reduced bank credit. And that I think will also keep inflation from going any higher than it is now. So I think those trends are still in place. It's just a matter of the data kind of catching up to it. But I think fiscal policy is really the key underlying driver. And because it is focused on improving the productive capacity of the economy, as opposed to kind of the tax cuts for corporations and the rich, then I think it's going to be more effective in both bringing inflation down and in keeping the underlying drivers of the economy going.
Are you concerned that the 10-year yield being high and perhaps might even go higher could actually raise the cost of borrowing for consumers, which is to say credit card interest rates would follow, mortgage rates would follow? Is that a possibility, Sam?
I think really that's already happened. I think mortgage rates being over 7% is a direct reflection of the move that the 10-year yields have made. And actually, mortgage rates are relatively high, even compared to treasury yields now. And I think part of that is the way the housing market dynamics have moved and the fact that the rates have risen so fast that it's kind of thrown off the traditional way that mortgages are priced and things like that. But I think overall, yeah, we've already seen a lot of that impact show up. Credit card rates are much higher now. Auto loan rates are much higher now. Mortgages are much higher now. So I think some of that impact is already being felt and will be felt over the next 6 to 12 months. But I think there's an offset to some degree, partly from the fact that one person's interest expense is another person's interest income. So if you own bonds or if you have money in the bank, you're getting more income now than you used to, which is helping to offset the aggregate impact of higher interest rates. And you've got the fiscal stimulus there to help build factories and put people to work and expand capacity, which is disinflationary in the long run and help support the economy in the shorter term. So I think those factors are all kind of balanced out a little better now than they were in previous cycles when you had both monetary and fiscal policy tightening at the same time, which is why you get a recession around this time typically.
Right. Now, speaking of spending, advanced retail sales continue to hit new highs in nominal terms. On a year-over-year change basis, it's actually increasing slightly. It was flat a few months ago. Are you surprised that consumer demand is still relatively strong despite higher borrowing costs that, in theory should be weighing down on spending because you've got less discretionary spending power?
That's right. And I think really the offset is the fact that the labor market itself, that more people have jobs and they're still getting raises, means that the aggregate income to support spending is still there. It's still growing at probably like a 5% annual rate in nominal terms still. So I think to the extent that retail sales are going to kind of move along with that nominal income growth in the longer term, not month to month, but in the longer term, means that you should expect to see some continued nominal growth in sales, even though higher interest rates are reducing the part that people are financing. So the autos and the houses and things, people are doing a bit less of. But there is still that income support there to drive spending, which is the biggest part of what drives spending. The cost of borrowing is a smaller component of it in net terms, again, because you have more interest income for some people offset by higher interest costs. So the net in aggregate is less clear. So I think the employment market itself being strong and the fact that labor supply is still somewhat constrained is helping those dynamics work in favor of continued nominal growth.
You're right. Real wages troughed in Q2 2022 as inflation rose during that time, and then it actually started to climb back up. So real wages is nominal wages adjusted for inflation. That's starting to climb back up. So yeah, in real terms, on average, people are making more money than a year before. Now, Sam, what would make people spend less money from now on?
Well, again, the big things will be if people start to lose their jobs, or the wage increases that we've seen really stop and start to go in reverse. I don't see that happening near term, but that would be the longer term concern. And I think otherwise, it's going to be if there are other shocks to the system of some kind. But I think to make people stop spending money, they have to be earning less money in general. I think the interest rates will slow things down for those parts of the economy that are more financed. So the houses and autos and things like that. But I don't think that anything's going to slow it down right away. I think it'll be more if companies see less demand and start to reduce their demand for labor and therefore start cutting hours. Temp jobs start to go first, hours start to get cut, then wage growth slows down, then you start to see layoffs after that. So if you start to see that kind of sequence of events really pick up, that would be the worry that would then drive spending lower.
Are you seeing any signs that employers, small or large businesses alike, are planning to lay people off, perhaps from the NFIB surveys or anything else?
Nothing so far indicates a dramatic shift towards trying to reduce staff. There are still some parts of the economy, the real service-oriented parts that are still trying to hire people and that are having trouble and having to raise wages. But I think in aggregate, there'll be sectoral shifts sometimes. But I think that in aggregate, there's still relatively strong demand for labor. I think the pace of new jobs growth has already been slowing a bit and will continue to slow. But I think that'll be more of a gradual thing as more people, have come into the workforce, and the greater percentage of people are already employed. Then there'll be fewer left to come off the sidelines. But I don't really see signs yet of kind of that reduced demand for labor or reduced demand in terms of revenues for corporations. Earnings estimates and sales estimates are still rising for, say, the S&P 500 companies. And so that tells me that there's still at least some signs of top line growth that will keep companies from laying people off right now.
Well, there's been some news that a lot of notable companies have gone bankrupt. And in fact, I'm just providing a counter argument here. The S&P Global Intelligence Research has found that, I'm just going to read a paragraph from their latest report, they recorded 64 corporate bankruptcy filings in July, the largest monthly total since March, and more filings than in any single month in 2021 or 2022. Filings in the first 7 months of 2023 surpassed total filings for the previous year and were nearly on par with 2021's full year tally. That is a huge number in terms of a monthly filing. Is that of concern to you?
Yeah, and I think that's it's a concern, and it's typically focused more on the smaller business side of things. And I think it tells you that there's been a lot of kind of rotation under the hood of the economy in terms of where growth has been and what kinds of businesses are going to struggle and which kinds are doing well. I think a lot of, for instance, the shipping companies, as an example, trucking, got a huge burst of demand immediately during and after COVID, as everyone was ordering things and buying things online, and a lot of capacity expanded. And then now, as people have shifted to back towards services and travel and going to concerts and things like that, and spending less on goods in the stores or online, then the demand for shipping has really come down quite a bit. So all the shipping, whether air or ground transportation, have really slowed down. And I'm seeing that in my work in terms of the industries that are relatively strong and relatively weak. So you saw Yellow Trucking, filed recently and is struggling. And so a lot of those kind of businesses have seen the downside of the post-COVID demand surge. So I think that's what we're seeing, is that some of the businesses that had a big boost and maybe overhired and overexpanded are now having to adjust, and in some cases file for bankruptcy, particularly since capital is now a little more hard to find. Interest rates are higher. A lot of the venture capital funding has kind of gone away that was there in 2021. All those things that had kept some of the newer or weaker businesses afloat have gone away. So I think that's what we're seeing now, is some of that adjustment. I think the big picture is still positive. Most larger companies are still doing fine, but under the surface, there are some of those rotational shifts from companies that had, that didn't have strong economics and are now facing tighter capital conditions.
On the subject of the labor market, you're right. So far, it's been strong. Hypothetically, what would make mass bankruptcies a reality? Because in order for layoffs to happen en masse, we have to have more companies going under. What structural shifts or changes in the macro landscape would need to happen for even more companies, perhaps even larger companies, to start filing bankruptcy? We're not even filing bankruptcy, but just significantly reducing headcount.
Yeah, in that case, I think you would either have to see a sharp change in, say, fiscal policy, where you have to be very contractionary. If there was a dramatic move to try to reduce the deficit and cut spending and raise taxes, that could potentially have that impact. I think if a global event, if China's economy which is already slowing, really fell off a cliff, there could probably be a wave of impacts from that. I don't expect that will happen. I think China will try to manage that, in a more gradual fashion. And then if there's another supply shock, a war breaks out, another outburst of COVID or something like that, some other sort of you want to call it a black swan, but maybe a gray swan that would be a shock to the system while interest rates are already high, while money is already relatively tighter. Then that would be potentially something that would dislodge the current momentum that we've got in the overall economy. So, I tend to sort of say that a lot of what's happened has been due to shocks and then the lagged effects of those shocks. And so if we can avoid any major shocks, we'll probably be okay. But those shocks could be either external from other parts of the world or from a major policy change here internally that would be most likely driven by politics.
Let's talk about China briefly. There's fear that the weakness in China could be imported, quote unquote, into the U.S., particularly from the consumer side. Is it possible that Chinese consumers will demand less of American goods? Would that have a significant impact at all?
It could, and certainly, because we run a big trade deficit with China, we sell them more than they buy from us. But I think the concern is that simply that their overall economy and their demand for a lot of different things, slows down too quickly, too rapidly, and therefore throws off companies that are leveraged to that in terms of trade or in terms of import export for needed goods here domestically. Except that isn't my base case right now. I think the Chinese economy will continue to kind of slow and struggle, but they'll probably manage to keep it from falling off a cliff. So I think it's going to be more of a slow grind lower for the Chinese economy and for the companies that are reliant on it. And I think in some ways it already has imported something into form of lower inflation. I think the fact that a lot of commodity prices, peaked in the middle of 2022 and have slowed quite a bit since then is what's helping our inflation rates come down. A lot of metals and things like that are heavily in demand in China are lower now because they've been reduced their demand for them. So I think there already has been an impact on global inflation and U.S. inflation from China's slowdown. And I think as long as it's a gradual effect, then it's fine. If it becomes a sudden crisis event, that would be more of a concern.
Okay. Let's talk about the Fed. Jerome Powell made a speech at Jackson Hole on Friday. We're going to get into that, but backing up here for a sec now, Sam. A lot of people last year have told me that it's improbable that the Federal Reserve would raise the Fed funds rate to 5 and 5.25. Here we are. Their argument was that the interest expense on paying down debt would be too high for the Treasury to afford. And I don't know about too high, but it certainly has gone up to a lot. Federal interest payments have spiked up to nearly $1 trillion, considering that federal revenue from tax receipts is only about $3 trillion. That's already a significant portion of tax revenues. Sam, why is it that the Treasury hasn't gone bankrupt yet from this?
Oh, well, fortunately, the Treasury itself can't really go bankrupt. They can print money and produce, pay their bills as much as they need to. And the question is really, what is the influence on the private sector and the economy of those higher interest payments, which is really, it's a form of stimulus deficit spending. Basically, interest payments from the Treasury go into the private sector and is money that people can spend. So the fact that the Fed raising rates means, that the Treasury then has to pay out more in net interest, and that money goes into people's pockets one way or another.
So how does that money go into? Can you just explain the mechanism here? How does that money go into people's pockets?
Sure. So basically, anyone who owns Treasury bonds, Treasury bills, anything like that, along with all the private sector equivalents of commercial paper and bonds, they're all earning more interest income now. In fact, a lot of corporations are earning, millions or in some cases billions of dollars on their cash holdings because they've got them in treasuries. And certainly, if individual investors or through their 401ks or their pension funds are all earning a lot more in interest income now than they were, say, 2 years ago. And that money is essentially coming from the Treasury. The Treasury is paying out more in interest to people who own the Treasury bonds than they were, a couple of years ago, and not collecting, as much or a proportional amount in tax receipts. So that means that the deficit is higher, and the deficit at the federal level is new money creation. It's money that the Treasury is spending not collecting in taxes, and that money then goes to the private sector, whether it's companies or individuals or whatever. That's money that's being spent in the economy. Now, the Fed can balance that a little bit by buying bonds or not buying bonds, and things like that. But really, that's the money printing that's going on. Essentially, it's coming from the Treasury, and that's how the money gets into people's pockets, is from Treasury interest payments, essentially, that go into the private sector. So the Treasury can print as much of that as they want. They can create money and pay interest as long as they need to. It's just a question of how much does that cause too much inflation, or does the money, sit in people's bank accounts and never get spent, or what there's distributional effects. There's a lot of other effects, but in aggregate, it means there's more money going out of the Treasury than coming in, which means that there's more money that the private sector has to spend.
Interesting. Would you go as far as to say that higher interest rates could actually be stimulative for the wealthy that own these assets?
Yeah, I think that's the thing a lot of people forget, is that you only look at the cost of borrowing for people who are borrowing money, but the interest income from people who are lending money or have money to save, who own treasury bonds or any other kind of other bonds or bank accounts, they're all getting a lot more interest now. And you're right, some of them will probably be wealthier people who have more money to invest, and therefore you'll see people who need to borrow money paying more, and people who have more money earning more interest. So again, there's a distributional effect, which may be net negative for the economy, just because wealthy people tend to spend money at a lower rate proportionally than people who have less wealth. But the net effect is still potentially stimulative, and it or certainly will offset the higher cost of borrowing for some people. So that's why I think even people assume that the Fed raising rates aggressively means the economy will slow down rapidly. That may not be entirely true, because there are these offsetting effects. All that new interest income is going to get spent somehow, one way or another. And I think that's partially, again, offsetting the higher cost of borrowing for other people.
I guess the concern initially was that higher interest rates, higher borrowing costs for the working class is more impactful than, I guess, the wealth effect generated by higher interest rates for the wealthy. And so you've got more people not spending enough money versus some people spending a little bit more money. But actually what we've seen is perhaps the wealthy carrying the economy forward. They're the ones that are continuing to spend and drive demand. Does the data support that theory?
Yeah, no, I think that's right. Yeah, there's definitely traditionally been that kind of gap, and they call it marginal propensity to consume. That people with less wealth and less income will spend more of new money that they get, and people who have a lot of wealth, they don't need to spend it on consumption right away. They'll tend to save more of it, so a smaller proportion of it gets spent. But there's still a fair amount of number of dollars that are getting spent either way, and so there's a definite balance. So net, there may be a slowing effect, because the less spending by people with less wealth is more than offsets the greater spending by people with more wealth. But there is an offset to that. And I think that is in part what's helping keep the economy afloat now, is that there is that sort of bonus from spending coming from people's higher interest income, as well as kind of the lagged effects of, for instance, like last year, Social Security checks for everyone went up like 8% because of the inflation from the prior year. So anyone who gets a Social Security check, got a raise, and went out and spent some, most likely. So I think there are those things that are lagged effects of inflation and earlier policies that are still being felt this year, even though inflation has come down, and those stimulus policies aren't there anymore.
Powell said on Friday that additional evidence of persistently above trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy. So the key here is further progress on inflation at risk. Are you seeing any possibilities of inflation either remaining high or even returning in light of everything we discussed?
Well, my general view is that inflation is kind of on its way down in a longer term sense. My assumption is that there will be wobbles back and forth in the data. I think the bounce in energy prices, for instance, that we've had recently will filter through into some of the headline CPI and PCE data, and could give a little bit of a bounce to inflation. But again, I don't expect that to be a longer term thing. And some of those prices have already come back in a little bit. So I think there's going to be a lot of noise in the data still, and it'll make inflation look like it's maybe not coming down as fast as they would like to see. My guess is the Fed probably realizes that they've done a lot already, and the policy rates are actually already pretty tight. And that as inflation comes down, even if policy rates stay where they are, then real rates in terms of policy will actually go up and become tighter. So I think they don't want to over tighten and be responsible for a recession. But I think they need to kind of keep their messaging on the hawkish side to make sure they don't declare victory too early, or before core inflation has really come down a little further. So I think by the end of this year, things will look better. And I think that probably there won't be much more in the way of hikes, but I don't think the Fed will be willing to talk about rate cuts until sometime next year.
So, Sam, you think the Fed's going to pivot by next year is your expectation? What would make them pivot then?
I think by next year, if we do see the inflation numbers come down closer to that 2 to 3% level that they really are targeting, they'll really have a less of a reason to say we need to keep policy very tight now, because if reported inflation really does come down where I expect it will be 6 to 9 to 12 months from now, that the argument for having rates at 5 or 5.5% will be a lot weaker, and that there might be still issues from the banking system, restricting credit and things like that, that might make them say, well, the economy could probably handle a 4%, policy rate rather than a 5 or 5.5% rate, and that would still be on the higher end of the range and still be above. Because remember, their long-term target in their statements of economic projections is around 2.5% for Fed funds for policy rates. So 5.5 is really high relative to that. So you could come down to 4 or something like that and still be, kind of tight relative to your long run view, but less than where we are now. So I think there's a lot of room there for them to maneuver as you go into next year if the economy, stays at a relatively modest growth rate and reported inflation comes down, the job market slows a little bit further, and they really, can't make the argument that the job market is too hot anymore. Once those arguments peter out, which I think will happen, by early next year, then I think they'll struggle to support the idea that rates have to be this high anymore.
People have pointed to 2008 as an example of what would happen to the equity markets once the Fed pivots or cuts the rate. So recall that in 2007, the Fed funds rate was at 5.25. The Fed started cutting rates as of August 2007. This was a year before 2008, a year before the Lehman collapse. Is that true, Sam, that historically that there is a precedent for rate cuts being negative for equities, and therefore we have to assume that this could happen again?
Well, I think the 2008 situation was certainly unusual and was the result of the underlying financial system, the banking system, and the mortgage market, being broken in a lot of ways and being massively over leveraged and really having a lot of structural problems. And then the higher rates, came along and kind of tipped over the Jenga castle, and that's what caused a lot of. And then the Fed then had to cut rates in response to that financial system, kind of dislocation. Now there have been other cycles where the Fed has really cut rates on a more sort of benign basis, either because the economy has just kind of been slowing by itself, inflation's come down, and they wanted to stimulate. So I don't think 2008 is necessarily the right example to look at for any kind of rate cuts. I think if there were a major financial dislocation of some kind, then yeah, the Fed would cut rates as a result of that. But I think the sequence of events would be a financial problem, and then the Fed cuts rates, not the Fed cuts rates, which then causes the financial problem. I think the Fed is more reactive than that. Typically, they're going to wait to see if the banking system has problems or other parts of the financial system have problems, money market funds, potentially things like that have been problems in the past. But right now, it looks like the banking system is okay. It's much better capitalized now in aggregate than it was. And there are no clear stress points aside from some of the regional banks that have had their balance sheets kind of get into trouble from owning bonds, 2 or 3 years ago that have lost a lot of value. But I think that's something that they can work out over the longer term, and that they've already convinced the markets that they will backstop depositors, even if they will not backstop the actual bank stocks, the bank companies themselves, in terms of losing money. So I think so far, the scenario of 2008 is not likely to play out this time, in part because they've learned some of the lessons and changed some of the rules.
Generally, then, is Fed cuts would be positive for equities?
I think they would if they reflect progress on inflation and simply, slower growth, slower job growth, and kind of an adjustment down towards what they think the long run view is. Going from very tight to less tight would be benign, would be potentially good for markets. If it's, oh no, something has broken, there's a terrible crisis, we have to cut rates right away, otherwise something will break, that would be a negative scenario. So I think it's really, why would the Fed be cutting rates? Is it simply because they see that they're too tight and they need to get closer to neutral, or that something is broken. And I don't see what's going to break right now, but those can always be surprises. But the housing market, I think, is still okay. The banking system outside of commercial real estate, I think, is generally okay and is better capitalized. So I don't see the immediate driver of a shock at this point, particularly with fiscal stimulus still relatively positive right now.
So bottom line, you don't think there's going to be a recession this year. Do you think there could be one next year or the year after?
Oh, sure. Yeah. Certainly looking further out. I mean, there'll be a recession at some point. But I think it's just a matter of, do we kind of gradually slide into it, or do we fall off a cliff? I think it'll be more likely a kind of a gradual slide into it, unless, again, there's some big fiscal policy change due to politics that causes a radical change in how fiscal policy is done. So I think what's going to happen is we'll probably gradually work our way towards slow enough growth and slow enough inflation that the Fed will bring rates back closer to kind of the maybe 3 to 4% range. That would be sort of closer to neutral in that scenario, and that we will probably avoid a recession this year and early next year, just given the momentum that we've already got. And that if that peters out and we don't get any more kind of fiscal support, then depending on how the politics turn out in 2024, then I think we could see a slowdown after that would be more meaningful.
On the bullish camp, I've heard in terms of projections for the S&P, I've heard as high as new all-time highs by the end of the year. So above 4,800 points for the S&P 500. What do you think? Is that possible?
I think that's possible. Certainly, yeah, by the end of the year, maybe early next year. If the earnings estimates right now for 2024 for the S&P, which are a little over $240 a share, if those in fact hold, which they may not, but if they hold, then you could easily get to paying 20 times or something close to that $240, which would get you to a 4,800 number on the S&P 500. So I think that's certainly a plausible scenario, particularly if it looks like the Fed is done for now and might cut rates next year a little bit. That could make investors willing to pay something like a 20 times multiple on a $240 earnings number. But those are kind of the more positive scenario if everything kind of goes the way it's going now, and continues as we expect.
We talked about sectors you like. Are there any sectors you don't like right now?
Well, the commodity sectors are, I think, probably going to struggle. I think there'll be certain sub areas there that do well here and there, but I think the demand from China being weak, and the fact that growth is slowing in the developed world in general, will keep kind of downward pressure on the commodity sector in general. Again, unless there's a big supply shock of some kind. And so I'm kind of underweight the commodity space. Healthcare has struggled for a while. There's a lot of mixed bags going on there, but it's kind of been lagging. And I think the technology kind of discretionary consumer areas still have some tailwinds. And I think the industrials have been doing well for a while. They may be at risk of slowing down at some point, but not yet. And so I think it's more a question of, are there macro drivers like commodities, or are there things like healthcare that just can't do as well when other sectors are doing well, particularly after COVID kind of messed up a lot of the economics for some of those businesses.
All right, excellent. Well, let's end it here, Sam. Excellent analysis as always. Appreciate your insights. Where can people learn more from your work?
Sure. So certainly millstreetresearch.com has a lot of the background and sample reports. And I would encourage you to follow Mill Street Research on Twitter or on LinkedIn. I post there fairly regularly, kind of just updating comments and macro views. You can kind of see kind of what I look at and how I think about things.
Final question before we have to go. What would change your mind on a positive economic outlook?
Oh, it would make it more negative?
Yeah.
Yeah, I think a policy mistake, either much more aggressive monetary tightening or much more aggressive fiscal tightening, would be the main things I would watch out for that would make me a lot more negative. And then beyond that, the kind of shocks from outside the system, wars and viruses and countries falling apart, things like that, which are just very hard to predict. But as we've been reminded multiple times, can't happen. So if they do, you'd have to watch out. But I think policy mistakes are really the key risk, I think.
Excellent. All right, Sam, thank you very much.
My pleasure. Thanks for having me.
And thank you for watching. Don't forget to subscribe.